Congratulations that you are here. You are at the right place with Sri Consultants, who has helped more than 3,000 families managing their assets. So in this video, what am I going to say? I'm going to say the top 5 mistakes that people generally do when it comes to money. Before I go to the 5 mistakes, let me tell you fundamentally why there is a problem. Right from our schooling till college and anywhere in the education pattern, whether it is a professional degree or a generic degree, nowhere are we taught about finance. And there comes the problem. Because if you are qualified well and if you are earning well, you are expected to manage money right from the 30th day. So let's dive into the topic as to the top 5 mistakes that people do when they are supposed to manage money. Number 1, most of the people are underinsured or not at all insured. Let's take the classic case of COVID. More than 5 lakh people died in India. And do you know how many of them had a term plan, a life insurance cover? Less than 20%. And that's an abysmal number considering the fact of the matter that life is very uncertain and in fact death is a certainty. So the first mistake is, if you don't have a life insurance and you are planning for any other investment, it's not going to work because you have not protected your basic. Point number 2, health insurance. Health insurance has become the most important product for the world. Not only Indians, but every single individual needs to have health insurance. Why? Look at the last 2 years. A pandemic struck the world and we are in a situation where we have lost more than 5 lakh lives and millions of people were hospitalized. Imagine, one hospitalization can wipe off 10 years of your saving if you do not have health insurance. And don't forget, if you have a health insurance, please have adequate coverage. The data says that more than 18% is the cost rise in hospitalization expenses, and from here on, if you look at Western data, it's going to keep on increasing. So having health insurance, an adequate amount, is extremely important for you. Otherwise, your hard-earned money might go all off in paying hospital bills. Third, not ensuring that your money is invested in the right place. Now, what do I mean by right place? What I mean by right place is where you can make returns higher than inflation. What is inflation? Inflation is the rise of costing for our day-to-day living on anything that we use. So if the inflation is at about 7%, any investment that gives you a return less than 7% is not going to make money, because what's costing you 100 rupees today, next year will cost 107. Imagine you have your money in a deposit, and if it's earning you about 6 to 7%, post-tax which will be only 4.5%, what really will happen is that your money is actually depreciating. So the third mistake is, have an investment which gives you return more than inflation. Fourth, when you are young, you at the highest probability of taking risk. But as you age up and you go towards your retirement, your risk appetite lowers. What do I mean by that? As you age up, the ability to take risk with your capital goes down substantially, and it is important that you switch your money from risk-taking assets like stocks or equity to safe assets like bond or debt or deposits. What typically happens in India is that most people invest their hard-earned money at a young age in deposits, and as they age up and they are nearing their retirement, they start dabbling with stocks. That's a grave mistake. In fact, you should be doing the reverse. The fifth and the most important point, please have your asset allocation proper. As in, do not have all your eggs in one basket. Whether it is equity, whether it is insurance, whether it is debt, whether it is deposits, gold or real estate. Please spread your assets. And what do we mean? If you have 100 rupees to invest, ensure that you take adequate amount of equity exposure when you are young, and then have money in the other assets. How does it help? What happens when the stock market cracks or crashes or there is a bear market? What really happens is, I would like to give you a small example to make you understand this clearly. Let's say out of 100 rupees, you have 60 rupees in stocks, 10 rupees in gold, 25 rupees in real estate, and about 5 rupees cash. Now let's assume what really happens is that the market crashes. In maybe 2 or 3 years of a bear market, your money might go down by 10 to 20%. So that's a depletion of 10 or 12 rupees in your asset out of 60. But in that same period, imagine whenever stocks go down, gold goes up. So you get compensated, and net at the end of 3 or 4 years, because you had your asset allocation and all your eggs were not in one basket, your 100 rupees capital wise gets protected, and you also make a decent return. So the 5 things that I said, just to repeat it: 1, ensure you have a term plan. 2, ensure you have proper and adequate health insurance. 3, ensure that you invest money where you make returns more than inflation. 4, ensure that you take the risk at the right age and not at the wrong age. And 5, have your asset allocation proper. These are the basics of finance, and this is just the beginning of all that you need to know about finance. If you're more interested, I would request you to click on and call us for you to get the right advice from the expert. Shree Consultants have been in this business for the last 18 years, handling more than 3,000 families and more than 400 crores of the asset. Given in the link below, we have a PDF which is a downloadable data PDF for your financial planner. Most people don't have their data properly stored. Download the PDF, digitally enter all the savings that you have got so that there is a record for you and your family members to see. So you have come to the right place. We've given you the basics of finance now, and I hope for more information, expert financial planning, call us now and get in touch with our employees. Thank you so much. Thanks again for coming and watching this video. I hope we would partner you in your wealth management.